I start then?
Sure.
Okay. Hi again, I'm Arhan. I'm a senior lecturer at the University of Huddersfield. So now I'm going to present one of my working papers in which I investigate the relationship between board independence and dividend policy for controlling agency problems in family firms. Like I said, it's a working paper. Any comments, suggestions, much appreciated. So first, I'd like to talk about the background of the study and explain why I specifically focus on family firms. Well, as we all know, the separation of ownership and control in corporations, especially widely held corporations, creates a space for potential conflicts of interest between shareholders and managers. Basically, shareholders are hire managers to run their firm on their behalf. Normally, managers are supposed to perform to maximize shareholders' wealth. However, in practice, this may not be the case, since they may act for their own benefit and abuse their controlling power. So at this point, traditional agency cost theory focuses on problems between owners and managers in widely held firms, mostly in developed markets. However, outside the developed markets, in emerging countries specifically, the publicly listed companies generally have concentrated ownership structures, especially families are the controlling shareholders. In this respect, previous studies show that agency problems function differently in family firms because families' direct involvement in management of their firms leads to greater supervision and fewer owner-manager conflicts. However, this creates another type of agency problem because when families hold almost full control, they tend to generate private benefits of control at the expense of other small or minority shareholders. So then the prominent agency problem is, in this case, is expropriation of wealth of the minority owners by the families. So normally corporate law provides potential and existing investors with legal powers to protect their wealth against expropriation in developed markets. But in emerging markets where generally poor institutional settings and weak shareholders' rights protection exists, this is corporate law may not provide sufficient powers for minority shareholders. So in this context, it's widely recommended by the previous studies, cash dividends could be substitutes for legal protection because by paying cash dividends, families distribute cash to other shareholders as well. Then this reduces the amount of free cash in families' control, which they may possibly misuse or expropriate. But then this raised the question, who decides to pay or not pay dividends? Who sets the dividend policy in a corporation? So basically the answer is board of directors. So, but previous literature showed that families almost always take the top executive positions and board seats. So this is up to them to pay or not to pay. In that case, who will monitor the family directors, managers' activities? So the answer is independent directors. In fact, agency literature suggests that due to their independence from the companies, independent directors can serve as an effective governance mechanism to monitor family managers' activities and minimize the opportunistic behavior. So, well, although governance role of independent directors and their possible impact on dividend policy is obvious and very important, especially in family firms, this relationship between the two is kind of under research. This is because previous studies have mainly focused on board independence and dividend policy in developed markets. So that's why the purpose of my study is to examine the influence of board independence on dividend policy for controlling agency problems in family firms in an emerging market where institutional setting and corporate structure differ from the developed markets. So to contribute new evidence to the dividend literature in this subject. So in order to achieve this purpose, I particularly focus on Turkey and examine the family firms listed on the Borsa Istanbul. So why Turkey? First of all, Turkey is one of the most important emerging markets and provides relevant setting for this study. Especially the ownerships of Borsa Istanbul firms are highly concentrated, typically dominated by families, and families in Turkey often attempt to govern their firms through corporate boards as well. And also prior studies show that the involvement of independent directors on boards in Borsa Istanbul family firms are very few. Although it is recommended by previous corporate governance rules set by Capital Markets Board of Turkey, they still seem to not appoint independent directors who may limit their controlling power. So at this point, Capital Markets Board of Turkey implemented a set of mandatory principles, which are the board should compulsorily include independent directors. It used to be suggested before, but now by this communique, by this rule, suggested strongly suggested recommendations converted into legal enforcement. So the number of independent directors cannot be less than 1/3 of the board. And in any case, at least 2 independent directors have to be on board. So this action enables the study how board independence influences dividend policy for controlling agency problems in family firms in Turkey. So that is the purpose I'm taking, but the particular research question I'm looking at. So there are 2 possible scenarios if there is a relationship between board independence and dividend policy. In the first case scenario, if independent directors are efficient monitor and family directors, and they will reduce the need for paying dividends, then this implies a negative association, meaning that they are substitutes for controlling agency problems. In the second case scenario, if the direct monitoring and supervisory power of independent directors are not good enough, not sufficient, then they would push for high cash dividend payments. So this implies a positive association, meaning that they are complementary devices. So the main research question I'm looking at is whether board independence and dividends are substitutes or complementary tools to reduce family minority owner conflict. So now I'm going to talk about the how I select my data. Using public disclosure of platform of Borsa Istanbul, I consider all firms listed on Borsa Istanbul all-share index. Then
Aaron, you have still 5 minutes, okay? Sorry if I'm interrupting you.
Are you sure? Because I have 18 minutes. It's just 10 minutes now.
Okay. It's
sure?
Okay.
Then I excluded financial institutions and utility companies. So this exclusion resulted in 227 companies, which contains 153 of them family firms. I verify family firms consider their direct involvement and also connected relationships. And I collected the financial data from Osiris database. and I hand collect the information on ownership and board structure. So final sample contained 918 family observations from 153 different family firms from 14 different industries over the period 2012 and 2017. So how I regarding the research design and models, I consider the alternative dividend policy measures. The first one was the main model. In the main model, I used the probability of paying a cash dividend, and I also use dividend payout ratio. Basically, board independence is my test variable. In addition to board independence, I also include a set of explanatory variables, which are proxying for governance characteristics and financial factors such as board size, family directors on the boards, CEO chairperson duality, audit committee size, and the presence of other blockholders. For the financial characteristics, basically I included profitability, leverage, growth, and firm size. I also included industry and year dummies into model. So for the indigeneity, I use 1 year lag values of explanatory variables, and then I run logit and Tobit regressions. So basically, when the dependent variable is the probability of paying a dividend, which is a dummy, if company pay dividend is 1, 0 otherwise, I use logit model. And for the dividend payout ratio, if it contains discrete and continuous variables, so in that case, I use Tobit model. So these are some I like to illustrate that about 41% of the total observations, Turkish family firms paid dividends, and the board structure, board size average was about 7 board of directors, and 32% was the independence, board independence, and family members sitting on the boards was about 30%. So these are my empirical results. When I run my logit model, I use full logit and random FX logit, and I also use that full Tobit and random FX Tobits when I'm doing Tobit modeling. So the likelihood ratio test suggested that random FX Tobit is more superior than pool. So I report my results on random FX Tobit. So I also run some extra analysis. I categorize my sample into different samples based on 5 different firm characteristics, which are profitability, leverage, growth, firm size, and the presence of blockholders. So I do that for Tobit modeling as well. So long story in short, this table summarizes my findings. So my findings show a strong and consistent positive relationship between board independence and dividend policy for both dividend payment decisions and dividend payout ratio. And also board size and audit committee size has got positive effect, whereas family directors is negative influence on dividend payments. However, CEO chairperson duality has no significant effect. So to conclude, my evidence, the strong and consistent positive impact of independent directors on dividend policy suggests that independent directors encourage the board of family firms to distribute cash dividends to reduce free cash flow from the manager's control. This may be, there are some possible explanation. Basically, they want to minimize what's left for expropriation and increase dividend-induced capital market monitoring. And then also they may want to establish a reputation of treating minority shareholders fairly. So referring back to my research question, because I said that if independent directors feeling that they're efficient, if their supervisory monitoring power is not efficient, they may push for high dividend payments. So that's the case. So then I conclude that independent directors and dividends are free governance tools to minimize agency problems in family firms in Turkey. So well, basically, my analysis based on the Turkish market. So that's why I call for further studies to identify similarities and differences to generalize my study findings. Thank you very much.
Okay, thank you, Ran. And Adam, it's your turn, I mean, to discuss. If you want to share your screen.
Okay, let me stop sharing my screen.
Sure.
Yep,
And,
there you go.
Right, please just give me a moment.
Sure.
Okay, so just confirm that you can see my slide.
Yeah, now we can see.
Perfect. All right. Thank you so much. Okay. So thank you, Erhan, for this interesting presentation. Thank you for this interesting presentation. I have been assigned the job of discussing your paper. Frankly speaking, I'm not a corporate finance guy. Though I try to do my best, at least in terms of preparing the paper for submission, to give you some tips and guidance and ideas from my behalf that perhaps may help, right? So the paper title is The Influence of Board Independence on Dividend Policy for Controlling Agency Problem for Family Firms. Just to give you a short recap, what you have heard so far, what Erhan examined was the impact of board independence on cash dividend payments of family listed firms. The study, the sample comprises of more than 150 companies listed in Turkey over a several year period. And it focuses particularly on a research period when Turkish authorities implemented a mandatory regulation regarding employment on independent directors on the board. And what the study demonstrates is a significant positive relationship, positive effect of board independence on corporate dividend decisions of family firms, which has certain implications, right, for dividend policy, right? So overall, I found the study interesting, nicely, properly written, providing novel contributions to the existing literature, at least as far as I know the corporate finance literature. So just to give you several, let's say, general comments, all right, general comments from my perspective that I believe maybe will help to make the paper more easier to publish. So my first point, it refers, to be honest, to my personal presentations. I like when the author hits the reader straight away from the very first paragraph what the paper is outlining, major objective or aim or contributions of the study. Because otherwise, and this is the case also of your manuscript, I literally had to go through first several pages of the paper to find out what are you actually doing in the study, right? So I think it would be better if you focused on the contributions, the very first paragraph, to be honest, right? Now, I would suggest that you consider including some more recent references, right, in the study, because when I went to reference list, I think the youngest reference is like 4 years old. And actually, this is the only paper cited that was published, I think, later in 2013, right? So, if the reviewer will see something like that, he will start thinking like, what is the problem? Okay, either you cannot publish the paper for the 8 years, which means that there is some issue, or maybe the field that you are researching is dead, all right? So I would include some more research references, okay? Now, the next point is the paper is relatively short. This is obviously nothing bad, but in such case, I think the paper will benefit from clearer structure when you clearly separate data, methods, and then the empirical findings, right? I mean, in your study, you somehow, interlink and you like systematically describe some parts of the methodology right away, followed by the findings, which is good when the paper is very, long and comprehensive. But if the study is relatively short, I think it would be better if you, put separately all the methods and then all the findings. Okay, you do. As far as I remember, you used random effects in the panel regressions. I think that reviewers frequently ask or appreciate if you provide some justification why did you choose random effects. So at least add some statistics from the Hausmann test, and I think it should be enough. I would accentuate more why Turkey provides unique playing field that provides some unique contribution into global corporate finance literature, because otherwise the paper may be sent back to some local journal. I would be actually, this is a bigger question, but I would be interested, since you give this clear census of 2012 when the new regulations were implemented, and you actually accentuated in this paper, to what extent it really influences the results, okay? So well, really there is the relationships in the market different between before 2012 or not. Now, and this is my final minor points. Okay, I would honestly consider deleting the very extensive and long equations that you have in the table notes, because whenever you have table notes, you outline the full equations for all the specifications in the table, which takes like half page. I think it's redundant. Okay, but this is just my perspective. Right? All right. I'm sorry that I had just one slide.
No, that's perfectly fine. Thank you very much.
I hope you can benefit from it.
Yeah, like I said, it is working paper. So I just put the main idea and my initial analysis for the conference at the beginning of the year, but then I didn't have time to complete it as full because of this COVID and everything. But yeah, the points you made very valuable, and then actually I'm working on those as well. Thank you very much.
Thanks.
Okay,
thank you.
Thank you, Adam, for your discussion. Anyone from the audience would like to ask something, to provide an argument or something? Okay, if no one is stepping forward, I have 2 comments reading your presentation. Thank you very much, by the way. In 2 seconds, is I would include a control for the dividend, a local control for Indian regression, just simply adding a fixed effect set of dummies. There is, evidence the dividend policy changes according to the local condition of the population. For instance, area with aged population means you have companies located there which tend to pay more. And the second one is, given your approach, your setting, since you have an exogenous shock by the law, I would try to a diff approach. Obviously, you have only your sample is after the shock, and I know it's an additional effort. I would spend something to have a sample going before and after, and running a diff analysis. It's
thank you. But before there was not many companies employing independent directors, so that's why comparing previously would be redundant, because the employment, most of family firms, they didn't employ independent directors. So that's why, yeah, I was thinking of that. What they were doing, they were employing managers working for their other business group companies as non-executive directors, which are not independent directors.
I know. I'm from Italy. The situation was quite the same. I know the story.
That's why I particularly focus on the post-regulation area. But yeah, I thought what you said, yeah, it was actually good. I could have the data for that.
Anyway, thank you. And
no problem. Yes, thank you.
Okay. Now it's we have the paper by again Andreas on the female board members and corporate performance. Your turn, Andreas. Are you there? You can.
Yes, I'm here. Do you hear me clearly?
Sure.
So I start with the paper, right?
Yep.
Okay. let me share my screen. Now, paper is titled Female Board Members and Corporate Performance in the Case of Bank Mergers and Acquisitions. We explore whether bank shareholders are any richer because they have women serving on board in the context of mergers and acquisitions and the respective event study analysis. This is joint work with Professor Tabakoulis from the University of Macedonia, Greece, Michael Neratsidis from the University of Hellenic University, and Nikos Kyoses, who is a PhD candidate at the University of Macedonia. I am with the University of the Aegean in Chios Island. So let's see the argument here. Now, the research question is, what is the effect of gender diversity on shareholder wealth? So if you have more women on board, will you end up being a richer shareholder at the aftermath of a merger announcement? So this is the question. Now, there has been prior research, which has motivated our work as well, that board gender diversity, shapes operational outcomes, operational dynamics, is a corporate governance mechanism. Let's say it increases corporate resources by adding a female window. It affects firm performance, sometimes positively, sometimes negatively, it depends. It affects risk taking because it has been found mostly in applied microeconomic analysis and studies that women are less risk averse than risk prone than men. And also it has been found that corporations with women on board, with more women on board, end up being more socially responsible. Now, there have been prior studies that have shown that gender diversity in terms of corporate decision making is motivated by the need to make decision making better. So if women are on board, perhaps companies will reach better decisions because they are more inclusive in terms of worldviews, or because it is better for society to have more women in positions of power and thereby boost economic development, not growth, development though. Now, in this context, gender diversity can be promoted either voluntarily, as the so-called lessor approach, or because it is mandatory in certain cases, or because it is promoted by regulators, policymakers. Now, there are many views. The agency theory says that actually assesses female board membership in the context of its effect on the quality of governance and therefore on the magnitude of agency costs and the outcome of agency conflicts. The resource-based view views female board membership as an increase in corporate resources, the female view being an extra resource on top of the male view of things. And of course, prior evidence on the effect of board and diversity on firm performance is mixed. Of course, it's mixed because it is sometimes hard to actually associate a specific financial outcome with gender diversity. Now, we focus on banks because bank directors play a special role compared to directors in other sectors. Have seen this in the literature, since they are accountable to unique nexus of stakeholders. Banks are especially regulated and they involve large nexus of and complex nexus of stakeholders in the economy. The importance of bank risk governance and the quality of corporate governance in banks has been stressed by regulators and policymakers. And it has been found in 2013 that board structure as a corporate governance element is actually a substitute or a vehicle for corporate control. So it matters. Board structure matters in banks. This is why we focus on banks. So we work with M&A deals where the acquirer, the acquiring company, the bidder is a bank for 16 years, 2003 2018. This amounts to 1,130 M&A deals. The target may have been public or private. We only include deals that have been initiated and included within the sample period. And of course, we had some winds rising criteria. The deal should have been more than 1 million in value, or more than 1% of the acquiring companies, like the acquiring bank's market cap. And we exclude successive deals announced by the same acquirer within 20 days. The data was drawn from Reuters, WorldScope, and 10K forms. Now, across the sample period, the percentage of women is increasing. There are more and more women serving on banks, on bank boards actually. Now, in terms of the descriptive statistics, the sample statistics here, what I would say is that we see that the lowest of the, actually we do expect and we do see, as is the case often in the M&A literature, negative cumulative abnormal returns for the acquiring company, and this reaches a bottom, reaches the lowest level in years 2010-2011. We see that intrastate deals are more than interstate deals. 57% of deals happen when the acquirer and when the bidder and the target are in the same state, and 81% of M&A deals are between banks. So only 19% actually of M&A deals cross the industry borders. Only 19% of the cases banks acquire a company which is not a bank itself. Now, 1 in 5 deals was settled in cash, 1 in 5 deals was settled in stock, and almost 1 in 3 deals was settled in a combination of cash and stock. We use the 4-factor Carhart model as a benchmark for normal returns, so as to assess the abnormal returns. The earliest estimation period was the 250-day period starting 21 days before the announcement day. We checked many different event windows and post-announcement windows as well. And we also tried various measures of gender diversity. One of those, we checked the Blau index, which is the gender diversity on board, the proportion of men and women on board, actually the proportion of women on board, more or less. We also checked the number of women on board, period, a simple percentage of women on board. So we tested different proxies of gender diversity. In terms of control variables, we included almost all of those that are often found in M&A studies. So we included board size, bidder size, deal value, relative deal value, which is deal value over the bidder's market cap, return on equity, volatility as a proxy of risk, leverage as a proxy of risk and of the availability of financial slack, dummies for intrastate acquisitions, for within industry acquisitions, for listing, dummy for listed companies, dummies for the method of purchase of the other company, cash only, stock only, or combination, worldwide governance indicators for the quality of governance in the case of international M&As. Now, what I would say here, these are some statistics continued. What I would say as what I would actually focus on is the fact that 73% of the companies had, of the banks in the sample, in the deals, had at least one woman on board. And also in the second line here, we see that almost overall across the sample, almost 10.25% of board members are women. Now, these are the announcement returns. Let me enlarge this a bit. Now, this is the first way to see this. We tested cumulative abnormal returns in companies in banks with no women on board and in banks with some women on board. Now, the announcement abnormal returns are practically nil. So women overall don't seem to matter. Actually, there's significance only at the 10% level in the -5.5 event window and -3.3 event window only. So no big deal here. However, if we split this sample in terms of before the crisis, during the crisis, and after the crisis, we see that that gender diversity is irrelevant to corporate performance in banks before the crisis. It is irrelevant also within the crisis if we see that the crisis lasts from 2007 to 2011 in terms of the full time span of re-establishing some order in the global financial system. But if we go here at the period after the crisis, 2012 to 2018, then we see that the presence of women on board significantly triggers lower returns for shareholders. So the negative signs here show that CAR is less, cumulative abnormal returns are less when women are on board the period after 2012. Now, instead of only checking what happens before and after the crisis, as in terms of comparing returns with or without women, we also tried all our different proxies of gender diversity, and also included all our control variables. So we had cumulative abnormal returns as dependent variable, and then we had as independent variables gender diversity proxies, all of them, and all the other ones about board structure and financial structure and so on and so forth. Gender diversity, almost in all cases, after the crisis, tends out to bear a negative effect on shareholder wealth when we're talking about banks who acquire other companies. Now, not so encouragingly so, most of our controls turn out to be insignificant, with the exception of the listing status of the target company and leverage as well. Now, we also estimated our results with robust standard errors. The results are the same. In the second part of the sample, actually the third part of the sample after the crisis, the presence of women on board ends up bearing a negative effect on shareholder wealth. To work with the heterogeneity and address heterogeneity concerns, we used the gender equality score per US state as an instrument and ran a two-stage least squares model. The results are still the same in the top line here, excuse me. The effect of gender diversity on cumulative abnormal returns is still negative. in the first line here. So this is robust. In terms of other robustness checks, we tried computing cumulative abnormal returns not with the Carhart model, the four-factor model, but with a simple market model, the S&P 500. We also switched our profitability measure from return on equity to return on assets. We measured company risk with beta instead of volatility, systematic risk instead of volatility. And we also used a different proxy for growth opportunities, where we checked for atomic skew instead of market to book equity value. And still in the very first line here, the effect of diversity on cumulative abnormal returns with all proxies ends up being negative and significant. So we find that if banks have women on board, then when they announce an M&A deal, then their impact on their shareholders' wealth is worse than in the case of banks with less women on board. Yes. Well, this is very important because it actually repositions. Actually, it may help reposition the argument about gender diversity. Of course, gender diversity is very, very important. But given our results here, I think that regulatory initiatives about gender diversity should be based on social or ethical arguments more, rather than simply financial. Because if you try to directly connect diversity with the stock market returns, the results will be weak in terms of supporting extra gender diversity. So if gender diversity and female inclusion in society in positions of power is to matter in terms of economic development, then the arguments, I think, should be more political or ethical or social, as opposed to strictly financial. Now, in terms of future research, of course, this can be studied in different sectors other than banks, and also can include survey analysis or qualitative analysis with interviews with women on board, and see how they perceive their roles in financial decision making, and then assess how their impact in board decision making may actually end up affecting corporate performance in terms of M&A deals. So thank you very much all for your attention.
Okay, thank you, Andreas, for the respectful time, and Anna, the discussion is yours.
Okay, thank you. Andreas, could you? Yeah. Okay. Okay. Can you see the presentation?
Sure.
Okay. So, what? My name is Ana Gómez Vázquez from University of Alicante in Spain, and I'm going to discuss the previous paper, Female Board Members and Corporate Performance, the case of bank mergers and acquisitions. Firstly, I would like to start by summarizing the main idea of this paper. The aim of this paper is to investigate the effect of the presence of women on board of directors on the economic impact of bank mergers and acquisitions. The authors tend to identify whether banks with at least one female director experience higher abnormal returns compared to banks with only male directors. In a sample of 1,130 mergers and acquisitions deals announcement by US banks, the authors find that gender diversity is associated with a smaller stock return after the global financial crisis. Related to the paper, I have some suggestions that I think could help you to improve the paper. Although this is not my topic and I'm not very familiar with the methodology. So, related to the methodology, As a robustness check, I think you could use a set score as a measure of banks' risk. And in section 2.1, I would include some references to justify your decision about the sampling procedure. And since you have data across different states, you might use cluster standard errors to account for heteroscedasticity across states. And now I have some comments about the way the results are interpreted. I believe that some statements are not completely precise. For example, conclusions on gender diversity drawn from an event study using the presence of at least one woman in the board of directors as a measure of gender diversity have to be more careful. In my opinion, it does not seem appropriate the final statement on section 3.1, and I quote, "This suggests that banks with male directors are able to create more value for their shareholders through mergers and acquisition transactions." Sorry. First of all boards analyzed have males, so the statement is not properly defined. You should have said banks with just male directors. Secondly, you are implying that the reason for a lower return in mergers and acquisitions for an average bank that has one woman out of 11 members in the board is the presence of that single woman. Well, I don't agree. Secondly, again, in the conclusion section, the definition of your objective is misleading. And I quote, "We explore the effect of female directorship on shareholders' wealth in the context of mergers and acquisitions." In my opinion, this is not what you are doing at all. As I said before, having one woman out of 11 members is an average board cannot hardly be described as female directorship. If you would have studied boards made up of just women or with a majority of women, then you could have done that objective. Another statement in the conclusion is not accurate, and I quote, "Banks with at least one woman on the board experience lower announcement abnormal return than banks with male directors." As far as the statistics in table 2 show, there is not a single board without men. Therefore, all boards have men and the implication is false. You need to be more precise because you are drawing a strong implication out of your results. And finally, caution should be put on regulation, as the author said, but also caution should be placed on statistical inference and recommendations. In this regard, a shortcoming of this research is the lack of literature review about gender diversity. I miss literature that helps the reader to understand when gender diversity starts to make a difference. That is, when can we say that a board is diversified? Could we really say that the board of directors in this study are diversified from a gender point of view? Is an average board with one woman really diversified, or even with 2 out of 14 members? So that's all. Thank you very much.
Thank you.
Thank you, Anna. Andreas, if you want to reply.
Yes, yes.
Minutes, yeah.
Yes. First of all, thank you for taking the time and the attention to review our paper. Your comments have been very helpful for me, and I would like to ask you to please, if it's possible, to send me your comments via email. Now, about board membership, female board membership, and financial performance, I would like to say that, as I said, actually, I share some of your thoughts, because as I said this at the beginning and at the end. It is difficult to actually associate strictly financial outcome with gender. I said this to start with. And at the end, I said that I am pro we are pro gender diversity, but I'm saying here out of this paper that gender diversity should be promoted on merits other than stock market performance. This was the argument. Now, about your argument about having one woman on board as being accurate, as being adequate or inadequate, well, we have also tried other measures, like let's say the number of women on board, or percentage of women on board, or the Blau index. So yes, I agree that having one woman on board may not matter, but we did this because it was done in the literature for reasons of consistency, and we also tried other measures as well. But yes, you're right, these things need caution. You are absolutely right about that. However, if we're talking about studies or prior studies that actually associate financial outcomes with qualitative aspects such as gender or age or nationality, the best that one can do to keep the refinement acceptable, if it's possible to be acceptable, of course, I'm not saying it is to actually include as many control variables as possible to actually isolate this effect. Having said that, having done this, this is the best that we can do, include as many control variables as possible. After we have done this, then we're left with a specific extra thing of interest, which in this case is gender diversity. Having said that, I'm saying yes, it is difficult to actually say that because a woman is on board, shareholders are losing money. But this, how should I say this? This rough way of saying this not refined way of saying this that I employed in this text is how these papers, this literature usually goes by. So if you are trying to associate financial markets with gender, you're about to write things that are not, very solidly supported, I think.
Okay, thank you. Speaking about control variables, if you may add one easy, I see, by the way, I like your paper, and so my compliments. I mean,
thank you.
Your tables, I mean, you have, at least to me, a missing fixed effect set about industry. You have only fixed effect about years, right? You could
yes.
Yes. Why not include fixed effect by industry? And
about the industry of the target company.
Yeah, sure.
Thank you. Yes.
And also, I mean, to me, I would advise to simplify the tables. You have, for instance, 8 models, and the first 4 are without, which is meaningless to me, right?
Could you please repeat this so that I can...
In your regression tables, the main one, you have 4 models without fixed effect for years, and the other models with fixed effect for years, right? Is the unique difference.
Yes, to see, yes.
Yeah, I mean, for me, there is a huge table, and if you decrease the size of the table, dropping the first 4 models without year fixed effect is fine enough. I mean, is equally fine.
Okay, thank you.
Okay, Jana, it's your turn, and please give your presentation. Okay, 18 minutes for you. Thank you.
Okay.
Thank you.
You're welcome. Okay. Yeah. Well, now I'm going to present the paper Lease Financing and Economic Development, New International Evidence Across 25 European Countries. Firstly, I would like to establish the motivation of this paper. Small and medium-sized firms suffer from severe informational asymmetries, short track records, and unreliable financial statements. And as a result, their access to traditional sources of financing is restricted due to they are perceived as risky firms. As a consequence, these firms have to face with adverse selection and moral hazard problems and higher collateral requirements which hamper the access to external financing. In addition, these problems might be more important in developing countries where severe informational asymmetries arise from weak institutions. Therefore, SMEs in developing countries could be more financially vulnerable and in need of alternative lending technologies such as leasing. Therefore, the objective of this paper is to analyze whether leasing becomes more important as SMEs operate in poorer countries, especially for those firms with more limited access to bank debt, and whether the factors that explain the deployment and use of leasing vary across developing and developed countries. Leasing has an important economic impact in Europe. According to Lease Europe, the European leasing industry continues growing, reaching 832.6 billion euros at the end of 2018. As for the use of leasing by SMEs, Lease Europe estimates that more than 20% of the total investment was financed via leasing, which shows the importance that leasing has not only in the European market, but also for European SMEs. And if we take the economic development of a country into account, leasing also has a great importance in Europe, in developing countries. In this table, we can see that the 10 countries with the widest split use of leasing are European, and 7 of them are EU10 developing countries. So, taking into account all this data, one could wonder why leasing is so important. To answer this question, we have to think the benefits that leasing offers. Leasing is a form of asset-based lending where the lessor is the owner of the asset and gives to the lessee the right to use it in return of certain payments during a specific period of time. From this definition, we want to emphasize some characteristics that we think help credit entities to deal with the opacity problems of SMEs in weak institutional environments. The first two benefits came from the fact that the lessor keeps the ownership of the leased assets that also constitutes the sole collateral for the financing. These two characteristics imply a clear advantage compared to other sources of financing, such as bank loans, since the process of asset reposition is easier under leasing. Secondly, leasing might reduce the consequences of asymmetric information. In case of adverse selection, previous evidence suggests that the asset is too important for the lessee's business operation to incur in default payments, reducing adverse selection problem, and related to moral hazard risk, leasing seems to overcome also this problem because the misallocation of funds is not possible, since leasing does not provide direct capital to the firm, and because the lessee might have an incentive to take care of the asset because of the purchase option, and because maintenance requirements that usually are included in the leasing contract, which reduces the risk that the lessor uses the asset in an inappropriate way. All these characteristics make leasing especially important for SMEs. So now I'm going to present previous evidence that support the objective of this paper and to establish the hypothesis of this study. Previous evidence shows that small and medium-sized firms are dependent on debt financing from domestic credit markets, which makes them especially vulnerable to asymmetric information problems created by poor institutions that are characteristics of less developed countries. In addition, increased risk arising from weak institutions leads banks to establish additional collateral requirements. However, most SMEs and more in less developed countries don't have enough assets to offer as collateral and end up suffering from more financial constraints. Therefore, the first hypothesis of this study is that SMEs are more likely to use leasing when they operate in less developed countries. In addition, Existing evidence seems to support the idea of leasing as a financing mechanism used by those firms experiencing financial constraints. For example, previous evidence provided in Italy, Germany, and in the US shows that financial constraints trigger the use of leasing. As for international studies, previous evidence finds that the use of leasing by large companies increases when the access to financing is a limiting factor for their investments. Therefore, the second hypothesis of this study is that the association between the level of a country's development and the use of leasing is moderated by the access of SMEs to long-term bank loans. Finally, previous evidence shows that country factors are especially important for small firms. In line with this evidence, we expect that the existence of lower institutional standards will make lessors in less developed countries more dependent on variations of country factors when they performing their due diligence on SMEs. Therefore, the third hypothesis of this study is that the likelihood of leasing for small and medium-sized firms in less developed economies compared with those in developed economies more dependent on country-specific characteristics. To create our sample, we use several data sources. Country data is obtained from the World Bank, the United Nations Statistics Division, Doing Business Indicator, and the European Central Bank. Firm-level data is obtained from the survey of SME access to finance carried out by the European Commission between 2005 and 2006. And finally, we arrived to a final sample of 3,530 observations from 25 European countries. Related to the method, to assess how the economic development of the country where the firm operates affects the use of leasing, we estimate logistic regression in this form, where L is a dummy variable that takes on the value 1 if the manager of the firm has answered in the survey if the company has already made use of leasing, and 0 otherwise. Development is our vector of economic development variable, FSC our vector of firm-specific variables, and CSC our vector of country variables. Related to our vector of development variables, we define several variables aimed at measuring the economic development of the country where the firm operates. In the first approach, we use country dummy variables. Secondly, we use the variable GDP, that equals the natural logarithm of GDP per capita. Thirdly, we include 4 dummy variables, which we have built dividing the countries of our sample in 4 groups according to GDP per capita quartiles. Using this classification, we build the dummy variables high, upper middle, and low income. And finally, we use the variable developing that equals 1 if the firm operates in one of the U10 and 0 otherwise. Each one of these 4 approaches are included in one of the regression of these first results. In column 1, we include country dummies, and we find the existence of 3 negative and statistically significant coefficients among the high-income countries, while for the low-income countries, there are 3 positive and statistically significant coefficients, which supports our first hypothesis. Next, in column 2, we include the variable GDP. In column 3, we include the dummy variable, high income, upper middle, lower middle, and low income, which serves as our base category. And finally, in column 4, we include the variable developing. As we can see, the sign and significance of all the coefficients of all these variables confirms the first hypothesis that firms operating in less developed countries are more likely to use leasing. Next, in order to confirm our second hypothesis, we divide our sample in 2 groups according to the variable bank loan. Bank loan is a dummy variable that takes on the value 1 when the firm has already made use of a loan longer than a 3-year term and 0 otherwise. The coefficient on the variable GDP is not statistically significant in column 1, while it has a negative coefficient and statistically significant in column 2. So this result confirms our second hypothesis, indicating that firms without access to long-term bank loans are more likely to use leasing when they operate in poorer economies, while the level of economic development does not trigger the use of leasing for those firms having access to long-term bank loans. And finally, we divide the sample in 2 groups according to the median of the variable GDP. Results confirm the third hypothesis, showing that leasing for firms in developing countries is more dependent on the soundness of the institutions than for firms in developed economies. In column 3, we find that SMEs in developing countries with lower income per capita and higher insolvency costs are more likely to use leasing, probably due to the existence of financial constraints. However, column 3 also suggests that the deployment of leasing in developing countries seems to benefit for the existence of public and private information registers, cheaper debt enforcement mechanism, and more political stability. On the contrary, column 4 shows that the use of leasing is more dependent in more developed economies, only depends on firm-specific characteristics, since we don't find any significant coefficient on country variables. So as final conclusion, our results show a great deal of variation across European SMEs in the use of leasing that can be traced back to differences in the level of countries' economic development. Not only is the deployment of leasing for SMEs more likely in developing countries than in developed countries, but its determinants are also different. Firm-specific characteristics seems to be the only trigger for these lending technologies for SMEs in developed countries, while country factors are also important determinants of finance through leasing in less developed countries. Lack of access to long-term bank loans also acts as a factor that intensifies the role of leasing for SMEs in less developed countries or in need of additional financing for their own specific characteristics. That's all. Thank you very much.
Okay, thank you for the presentation. And the discussant is Silvia.
Yes, I'm here.
Thank you very much.
Yeah, let me just,
May I ask you one first? I mean, actually the program I have for this session could be wrong, and I skipped the Adam's presentation, Zaremba. Unfortunately, the guy has to leave for personal reasons, which are understandable. So, Silvia, after your discussion, may I ask you if you could let Adam present and then postpone yours? It's an issue?
Of course, no problem.
Okay, thank you very much. So it's settled. Thank you, guys. The discussion is, your discussion, Silvia, your turn. Thank you.
Okay, let me just share my screen. Bear with me a second. I hope you're seeing the slide. Yeah. Okay, so thank you, Andrea, for the introduction, and thank you, Anna, for giving us the presentation on your paper. My name is Sylvia, and I'm from the University of Edinburgh. I'm going to just discuss Anna's paper on lease financing. So just a quick overview of the content of the paper. So the paper examines the association between the use of lease financing and the country's economic development. There are three main hypotheses in this paper. So the first one is SMEs are more likely to use leasing when they operate in developing countries. And the second one is access to long-term bank loans moderate the association between economic development of a country and the use of lease financing by SMEs. The third hypothesis is that country-specific characteristics are more relevant to the use of lease financings by SMEs in developing rather than developed countries. So in terms of the methodology and the data used, the authors used the European Commission's SME Access to Finance survey data and obtained a sample of 3,530 firms from across 25 European countries. They're running logistic regression models to explain the likelihood of leasing using variables on, for example, economic development, such as log of GDP and Euro 10 versus Euro 15 variables, dummy variable, and also they include firm-specific characteristics and country-specific characteristics to explain leasing decisions. So the key findings of the paper include are as follows. So for the first one is related to the first hypothesis. So the likelihood of using lease financing decreases with GDP and increases when a firm operates in a less developed country. The second finding is related to their second hypothesis. They examine and find that SMEs without access to long-term bank loans are more likely to use lease financing if they operate in less developed countries. And this is also the case if they are younger, growing, or have a deteriorated debt situation. With regards to their third hypothesis, the authors find that in developing countries, leasing by MSCs depends on both firm and country-specific characteristics. These country-specific characteristics could be, for example, existence of public versus or private information registries, cheaper debt enforcement mechanisms, and political stability. However, in their subsample of developed countries, the authors find that leasing by MSCs are only dependent on firm characteristics. So these are like a summary of the findings and the arguments in the paper. So let me move on to some of my thinking and suggestions. So in the paper, especially in your results table number 7, where you show results for hypothesis 2 and 3, the results are displayed based on subsamples, right? So columns 1 and 2 are whether firms have access to bank loans or not, and the third and the fourth columns are whether they operate in developing countries or not. So you're essentially splitting up your samples. So I wonder, how do these different columns compare? I know you have like different coefficients and they have different significance from column 1 to 2 and 3 to 4, but have you got any formal statistical test to assess whether the differences in these coefficient estimates are significant? So that might also help you answer the research, your hypothesis 2 and 3. And also because you're looking at, for example, in hypothesis 2, the moderating effect of having access to bank loan, I think it may help if you have a interaction term instead of just splitting up your sample. So you could have the bank loan dummy interacting with whatever your measure for economic development is. For example, you can use log GDP, or you can use the categorical variable for high or low income country as an example. And also for your third hypothesis, where you split, as in your paper now, by developing versus developed countries, you could try maybe use that dummy variable to interact with the country-specific characteristics and see whether the coefficient estimate is significant, which then directly indicates whether there is a difference between developing and less developed countries. I hope that makes sense. So there's also other 2 suggestions. So first, I see in your summary statistics table in your paper that the number of observations, so the number of firms actually differ by country. So there are, for example, I remember Malta has sort of disproportionately small number of observations. So I wonder if some form of weighting could be done in order to avoid your results being driven by a handful of large countries. For example, Germany, Italy, and France. I noticed that they have quite large number of observations. So one example of weighting method is done by McLean, Zhang, and Zhao in 2012. So they used equal weighted on each country. So you're essentially expanding your sample size to make countries have equal weights in your model and analysis. So another suggestion possibly is that regarding your country level characteristics. So there's a paper by Laporta quite early on in 1997. They argue that legal origin has a significant impact on the development, the breadth of debt market in countries. So what they argue is that the French and Scandinavian civil law countries have a narrower debt market compared to the common law countries. And that this sort of difference could not be confidently explained by their variable of creditor right index, which I looked at is similar to the one that you're using in your paper. So I think it might help to add this variable as an additional characteristic to help you answer a research question. Yeah, that's the end of my comment. Thank you.
Okay, thank you. Anna, if you want to reply, 1 minute or...
Okay. Thank you very much, Sylvia, for your comments. I really appreciate if you could send me your discussion by email, please.
Yeah, of course, no problem.
Okay.
And that's all. Thank you very much, Sylvia.
Thank you, both of you, and Sylvia especially. So Adam, if you want to present, the discussion is by Andreas. Hopefully, Andreas, you have the discussion, because if you have my version of the program, you won't have anything. Anyway, Adam, it's...
yes, I have the discussion, yes.
Thank you. Sorry, guys. I don't know why. Anyway, Adam, are you ready to present? Yeah, okay, fine. We can't hear you.
All right, now,
okay.
Just to make sure that you can see my slides. Perfect. So I would be pleased to present our study titled Momentum Spillover from Government Bonds to Equity Markets. Robert Bianchi is from Griffith University, Australia. Long is from Zhejiang University in China. And this is still a working paper. We have not submitted anywhere, so we will be happy with any comments and suggestions on this work, right? So this is my agenda. I'm going first to introduce the topic, then I will go through data and research methods. I will show my baseline results. I will speak a little about the potential sources of the phenomenon that we observe here, and finally we'll conclude the study, right? So the paper is about asset pricing and equity anomalies, but at the country level. The asset pricing literature has so far documented really hundreds of different asset pricing anomalies related to each other in different ways. But what is remarkable and very interesting is that some of them, the most established ones like value, momentum, seasonality, low risk, they do not only exist in equities, but they are present across a range of different asset classes. I mean, similar effects are documented in corporate, government bonds, in currencies, commodities. So they're truly like cross-asset class phenomenon. What is even more interesting is that some of these anomalies are visible across asset classes, meaning that signals from one asset class help to predict the performance of assets from a different asset class. Like, for example, we have some evidence that the momentum effect from corporate bonds spills over to relevant equities, or the momentum effect from CDS spills over to relevant equities. So in this particular study, we focused on slightly different asset universe. Namely, we focus on the relationship between government bonds and equity markets, and we ask ourselves a question whether the momentum effect spills over from the government bonds to the respective equity markets. Okay, and if so, why does it happen? So in other words, do the signals on the past performance of government bonds help to predict the future performance or the relevant equity markets in the cross-section, and why, right? The government bond markets are frequently dominated by really long-run trends. For example, in the US and many Western financial market, we observed that the interest rates were falling like constantly for the last 3 or 4 decades. So we feel that in order to examine this type of question, we need a really comprehensive type of data set. So we use country level study with country level data. We focus on indices representing the bond and equity performance in different countries. For better coverage, we merge 2 different databases, namely DataStream and Global Financial Data. So in the end, we amass a pretty big data set covering more than 60 countries, developed, emerging, frontier, for the study period spanning over 100 years. So our data sample runs from January 1900 till the last year. Okay, obviously the number of countries covered in the study is not stable through time. We start in the beginning of the 19th century, 20th century with slightly less than 20 markets, and then it grows gradually out to around 60 markets right now. Our basic, the question we ask is whether the momentum spills over from bonds to equities, right? In equity market, when we measure the momentum effect, we usually proxy it with simply past total return. Past total return, so like change in price, accounting for dividends and other capital distribution over some period, usually over the last 12 months. Since the mechanics of the government bond markets are slightly different, in this case, we don't really use the raw prices, but we rather focus on change in yields. So we proxy the basic return predictive signal in our case, which is the spillover from bonds to equities, as the change in yields over the last 12 months. Please note that the order here is reversed. So if the yields decline, the basic return predictor would be positive, and if the yields goes up, the basic return predictor would be negative, which is to align. This is basically for the presentation purposes, right? We control for all the most established return predictor for country equity indices that you can find in the literature, which is like momentum, skewness, beta, idiosyncratic risk, seasonality, long-run reversal effects. Okay, our toolset is not particularly sophisticated. As a usual asset pricing study, we use primarily cross-sectional regressions, originally stemming from Fama Macbeth, as well as portfolio sorts, so one-way sorts, two-way sorts. And this two-way sorts, we evaluate the portfolios with an ad hoc asset pricing model, including long-short factors based on all the different predictive signals that we have here. So in other words, we just want to make sure that we really deal with an independent asset pricing phenomenon, right? So let me just move to the baseline results. What you can see here is the performance of quintile portfolios. So every month we rank all the equity markets in the sample, sort them into quintiles, and form equal weighted portfolio. And we rank them on the 12-month change in the government bond yields. So what you can see here is that the countries with the biggest decline, or in other words, smallest increase in the government bond yields, significantly outperform the countries with the smallest decline, or in other words, largest increase in the government bond yields over the last 12 months. The difference between the quintiles of the countries with more extreme changes, so the biggest decline and biggest increase, it's in this case 0.63% per month, with the associated t-statistic exceeding 5. So it doesn't look like an, let's say, statistical artifact or anomaly of this type. The abnormal performance remains significant even if we hit it with all the different asset pricing model, including this broadest 8-factor asset pricing model, covering all different return predictors that we have. We also confirm it with GRS tests, with some simulation-based tests of monotonic relationship, and it only clearly points out the markets when the yields decreased in the past tend to overperform, while the markets when the yields tend to increase in the past over the last 12 months tend to underperform in the future. The effect seems to be quite robust and stable. It's not just the effect of some group of countries or some specific time period. You can see that this long-short strategy gradually earns profits over more than a century. But what they are particularly interested is to make sure that this phenomenon is not simply some different asset pricing anomaly in disguise, that it really represents independent asset pricing effect, which is not subsumed by any other effects that we have know from asset pricing literature. So what we do, we perform two extra tests. One is we form portfolio from bivariate sorts. So we first sort on some different asset control variables, like, value proxied with dividend yields here, past returns, past beta, idiosyncratic risks, skewness, reversal, seasonality. So all this stuff that has been documented to predict returns on country equity indices. And then we sort again on the change in past bond yields, and we examine whether there is some effect. So it clearly does not explain. So, and none of the other well-established variables is able to explain what we see as a result of the bond yield change. Okay, the major drawback of this type of analysis, I mean, bivariate sorts are very nice. They do not impose any functional structure on the relationship between the dependent and independent variable, but it's difficult to account for more than one or two control variables in this way. And we also apply panel regression using several different specifications. But no matter what we do, we always see that the momentum spillover from government bonds to equities is a significant and reliable return predictor of future returns that has not been documented yet in the literature. Okay, so having established that it is there, and it doesn't seem to be just a matter of some luck or an accident or some statistical artifact. So we ask ourselves a question: why do we see it? All right? Why do markets? Why do past changes in bond yields predict future equity returns? And we basically put forward three hypotheses that we test in this study. First, data snooping. Second, exposure to macroeconomic risks. And third, like as we usually do in finance, when you don't know how to explain it, we say that perhaps it's behavioral finance, and precisely we turn to investor underreaction, right? So there's a very large and rapidly growing literature recently trying to demonstrate that a lot of these hundreds different asset pricing anomalies that has been discovered and documented are actually false discoveries, because if we do sufficient amount of data mining, for sure we find something. Well, there's no better way to defend against data snooping argument rather than perform very extensive robustness checks, and this is what we exactly do here. Okay, so we check alternative skip periods, formation periods. We try to implement it with different fixed income securities. So for example, based on T-bills, we examine local returns expressed in currencies. We examine performance in subsamples, periods of different market states, different calendar modes. We examine the role of time varying, cross-sectional varying limits of arbitrage and country-specific cultures. but it doesn't work. Okay, it seems that the effect is very strong, it's reliable, and it's not explained. It's not like a phenomenon driven by some particular market state or market segment. So the second thing we check is that perhaps it's just a proxy of some kind of risk. Okay, very frequently the anomalies that are thought to be inefficiencies of some mispricing are then argued to be just a representation of some risk, some additional source of risk that is not captured by the most well-known asset pricing models. And this might be a case of this bond yield change. I mean, when the bond yields decrease in a country, then very frequently it's an acid test for some profound problems like macroeconomic downturn, which is being coped with the decrease in the yields or something like that. So we do examine whether our effect may be explained as being a proxy for macroeconomic risk. So we performed 3 different exercises. We examined the performance within the high and within the periods of good and bad economic states, let's say it this way, differentiated by different levels of inflation, GDP growth, unemployment rate. We also do bivariate sorts on macroeconomic variables and the spillover. Finally, we replicate one test of Cordia and Shivakumar when we split the returns into the components based expected or predicted by the macroeconomic variables and unexpected components, but we do not find any evidence showing that this might be due to macroeconomic risk. No, so we turn to our third explanation, behavioral finance. Namely, we think that it might be due to investor underreaction. So we build a story that investors underreact to bond yield changes, to the changes in interest yields, and this mispricing is corrected over time. Right? We do some minor tests. Okay, the problem with behavioral hypotheses is that frequently they are very difficult to be explicitly examined to say yes or no. So we do some minor tests to check it. Precisely, we examine the post-formation performance, and we put forward one of the reasons why actually investors may underreact, which is anchoring. So we argue that they anchor on past performance. They also try to provide some supporting evidence for that. Right? So what do you see here is the cumulative performance within the first 60 months following the formation of the long-short portfolio based on past bond yield changes. This is the black line, while the dotted line is the behavior of the regular momentum strategy in the equity index markets. I posted this momentum in the background, this regular momentum in the background to show the difference. So what you can see with the regular momentum is that the portfolios, the momentum strategies accumulate profits for, let's say, several 8-9 first months, but then afterwards this effect is corrected, turning into overreaction and ending as a reversal effect in the end. So we clearly see here this overreaction effect. The investors initially overreact, and then the phenomenon is reversed. Now, on the other hand, when we take a look at the spillover effect, there's no reversion here. This looks like a classical picture of underreaction. So we see some profits going on for the first, let's say, 12 months after the portfolio formation, and then the flat line, meaning that the signal no longer predicts any returns. Right? The second and the last test that we perform is, we think that it might be due to anchoring. Okay, so the investors anchor on past yield levels. There's some literature showing that anchoring really plays a role in finance and in asset pricing. So, if they anchor, then we assume, following some other literature, that the suddenness of this change in the yields may matter. So the more sudden, the more recent is the change in the yields, the more important it should be, because then the investors, have less time and less activity to react. So we put additional variable in the cross-sectional regressions, which is called sudden. These sudden variables represent the maximum maximum yield change over the preceding 2, 3, or 4 months. So it shows how abrupt and how recent is the change. And we see that it really matters. Okay, so if we include it in the equation, it helps to predict the future returns, and it actually diminishes the role of the spillover effect by itself. So it kind of supports our argument with anchoring, right? So let me conclude, right? What we demonstrated in this study, to the best of our knowledge, I think we are the first to show that the past changes in the bond yields are not immediately discounted in prices, but they tend to predict future returns in the cross-section of countries. Precisely, the countries with falling yields outperform the countries with increasing yields. The effect is not explained by any of the well-known, asset pricing phenomena that drives the cross-section of country equity returns. And we argue, we put a hypothesis, and we think that our findings are consistent with it, that this is due to investor underreaction stemming from the anchoring effect. We think that the study not only provides practical, new insights into international asset pricing in international markets, but it could be also practically implemented in global portfolio management. Precisely, it could be used for international asset allocation, and we show it also in the study, right? So this was my last slide. So thank you very much for your time and for your attention, and if there are any comments, I will be more than happy to hear them, right? Thank you so much.
Thank you, Adam. And the discussion is from Andreas, and go for it.
Thank you, Andrea. Just let me share the screen. Do you see the screen?
Almost. Yep.
Okay. There's momentum spillover from government bonds to equity markets. The authors are Professors Zaremba, Bianchi, and Long. To paraphrase Professor Zaremba from a few minutes ago, I'm not an asset price guy, so this is a bit challenging for me, at least. So the question is, so I will present an overview of the contribution and some comments at the end. The question is, what drives the momentum spillovers? This is one question. The second question is whether these spillovers include some hint about the predictability of stock returns. And if then stock returns are predictable, then what about portfolio selection? What profitable portfolio selection exercises can be run that make use of this effect? So they find that there are momentum spillovers from government bonds to stock markets, but the zero investment strategy, starting with no money at all, and shorting the markets where the yields, the government bond yields rose, and going long on the markets where the government yields previously fell, yields an excess 0.63% return, which is robust across a large battery of asset pricing tests. Now, the authors employ diverse specifications and asset pricing narratives to assess the robustness of their findings, and they are robust. And the spillover effect is not attributed to data mining or macroeconomic risks, leaving the behavioral asset pricing explanation as the most plausible one. There are 61 countries in the data set, 120 years, more or less, 48,000 or something monthly observations, 12-month changes in government yields, and asset pricing control variables for value effect, for momentum effect, for systematic risk, idiosyncratic risk, even skewness and seasonality. This is a 20-year estimate, obviously taking 20 years off the sample. And momentum effects like the reversal effect, 60-month returns, and assessing there the, removing the most recent 12 months, assessing there the the effect of past returns on subsequent returns. There are 3 asset pricing models for robustness: single factor, market, 3-factor, Fama Friends, and 8-factor one. They run a simulation-based test on whether portfolio mean returns and alphas increase with bond market momentum. So whether momentum strategy based on spillovers from government bonds to stock markets yields positive alphas, and they use the Glossen-Ross Shanken test on asset pricing alphas being jointly 0. So there are many ways to actually assess to disentangle this effect from well-known patterns, cross-sectional patterns in international asset pricing. It's also the use two-way sorted portfolios, homomathematic regressions, and two-way clustered robust panel data regressions. They find that the spillover effects exist and they are important for asset pricing. They use several tests to assess whether this is due to data snooping. The answer is no. Even if they use T-bills instead of treasury bonds, even if they assess the momentum across diverse market states based on, let's say, volatility, momentum, bull or bear, and the dynamics of the T-bill yields. Even if they use local currency denominated returns, the effects remain. Even if they use alternative strategy implementations like the naive risk parity portfolio, or they use past volatility to actually scale the momentum effect, the effect remains, and it does contain implications for asset pricing. Now, the question is it due to exposure to macroeconomic risks? This is a very reasonable question, because I've all heard that stock market reflect economy-wide fundamentals, but it's not the case here, because even if we do include GDP growth and unemployment and inflation, well-known macro variables, the effect remains. Now, there are many ways, of course, to assess macro variables. This is very robust, but if we stick to the later part of the sample, there are many, over the last decades, there have been many alternative measures of macro climate, of macroeconomic conditions and business climate. Now, this was partly a suggestion, and yes, they found that this was due to investor underreaction. The main study approach showed that the momentum returns are reversed, whereas spillover returns are persistent, and momentum spillover provides a reliable forecast of subsequent stock returns in most countries, and this, of course, yields improved Sharpe ratios when it is exploited in the context of a portfolio selection strategy. So this is very important. Now, assessment. This paper is excellent. There are not. I wouldn't use any many other words to describe it. This is a very ambitious work. I expect to see this published in a top-tier journal. Now, the sample is impressive. The robustness checks are extensively thorough. The econometric analysis is extensive, and there's solid background. The paper is very dense in terms of arguments. There's solid background in terms of theoretical arguments and prior research. Now, some suggestions. The number of countries across the sample period increased from 12 to 61. I would like to see a more extensive, more detailed account on the criteria of including or excluding a country. This was not, I think, this was not put down in detail in the paper. Now, they said we generally expect our early data in the sample to be of poor quality. And they said in the paper that, of course, this runs in favor of the H0, the null hypothesis, so we don't correct for this because it runs counter to our argument. So by leaving this thing as it is, it makes harder for us to prove our argument. Therefore, if we prove our argument, it shows that our argument is very, very strong. However, I would like to see a more detailed analysis here on how the poor quality of the data set in earlier periods affects the quality or the robustness of the tests. I mean, what does it mean for the econometric analysis to have poor quality of data for each part of the analysis or the simulations? Now, The authors could include, alongside cultures across countries, the quality of institutions, because it has been found in a paper by Sheriff and Chen, 2019, in the British Accounting Review, that profitability of momentum strategies also depends on the quality of institutions across countries. It's not only about cultures. Now, another thing, the authors also proxy transactions costs, and I suggest that they use as a robustness check some illiquidity proxies for as proxy of transaction costs, like let's say the amichood, like an amichood style ratio. The paper is very well written, but it does still need some polishing for language. The language is very good, but there are details here and there. And I think we should see more extensive suggestions for future research, because it's very, very brief at the end. The conclusion and the suggestions for future research are very, very dense. I think they should be elaborated upon. So that's all from me. Congratulations again on this great paper.
Hey, thank you, Andreas. Adam, if you want to reply.
No, thank you. Thank you so much for your time, effort, and for the suggestions, right? And for the nice words. Thank you.
Someone from the audience, or we could move on. Should be the Sylvia's time. So it's up to you, Sylvia. Thank you again for postponing your presentation. Okay.
No problem. Shall I start?
Okay, sure.
Okay. Can you guys hear me?
Yeah, sure.
Okay. Good afternoon. My name is Sylvia. I'm from the University of Edinburgh, and I'm really glad that I can be here today to present my paper. The title of my paper is Sustainable Investing Driven by Altruism? Evidence from Shocks to Philanthropy. Now, this paper is with collaboration with Dr. Maria Bochkova and Dr. Angela Gonzalez, both from the University of Edinburgh. So let me first give you some background about sustainable investing. So sustainable investing is really a more recent notion that has its sort of roots in an earlier concept of corporate social responsibility, which we call CSR. Now, over the past decades or so, the public, especially the millennials, was growing more attentive to CSR, and at the same time, there's also accompanying these sort of societal value shifts. There are regulatory changes, for example, mandating companies and in some countries, professional investors even to consider environmental, social, and governance factors into their practices. So the UN Principles for Responsible Investment find that between the years of 2006 and 2019, the size of the sustainable investment industry did grow quite substantially by 12.3 times. So this huge growth is and the increasing demand for SI are studied by academics as well, and the current evidence are suggesting that there is non-pecuniary motives that are behind the growth of SI industry, and one of those non-pecuniary motives may be altruism, and this is exactly what we're going to examine in this paper. We're going to see whether altruism is the key driver for SI demand. So just to further motivate this paper and talk to you a bit more about the relevant literature here, let's take a step back and think about before the emergence of SI. So before the concept of sustainable investing, if you are an institutional or a private individual investor and have available funds, you could allocate them either to conventional funds or donate to charity, or do a combination of both. So as far as conventional funds are concerned, the main motivation for investing in these funds are monetary. And if we think about why people donate to charities, there could be, for example, altruistic motives, or you could be trying to signal your wealth. And also because donations are tax deductible in countries, there's also the monetary motives of making donations. Also, some researchers suggested that it is a purely preference-based decision where people are donating based on what specific causes that they're most emotionally related to. Now, if we think about sustainable investing, it could be considered to some extent as satisfying both the motives that are listed out here from conventional funds and charities. So in some sense, it could be considered as a combination of conventional funds and charitable donations. So for example, Graf Zeman and Small propose that, if you own shares in a pro-social firm is essentially equivalent to having a charity conventional fund investment bundle. So let's take a look at the motives for investing in sustainable funds in more details. So the first type of paper that I want to highlight is the sort of theoretical work on preferences for SI. For example, Pedersen and co-authors, they've developed a ESG efficient frontier where the investors with preferences for ESG can actually achieve a tangency portfolio given a certain ESG score, but this portfolio is going to be inferior than the market tangency portfolio. If we look at the empirical evidence that examines why people invest in SI, this paper tend to exploit the common monetary motive between SI and conventional funds. For example, Barbara Morse and Yasuda, they find that investors in sustainable assets are willing to accept a range of 2.5 to 4.7% return discount in order to hold sustainable assets. And similarly, Rainbow and co-authors find that the socially responsible funds in their sample underperforms their domestic benchmarks by about 2.2 to 6.5%. However, in all of these studies, by Rainbow or Barber, they find that the growth in demand for SI measured in flows are constantly growing over their sample period. So, all of these papers that are listed out just now are kind of falling in line with the general taste-based setting, as in Pharma French 2007, in the sense that they acknowledge that there is a discount or there is preference, but they do not specify where is this preference coming from. And one of the preferences, whether it's signaling or something else, and in this paper, we're going to examine the altruism as being one of those non-financial motives or a source of preference. So, our research question is just going to be whether altruistic motive drives SI demand. But before I go into our research design, I just want to highlight that in the previous literature that are discussed here with exploiting monetary incentive between SI and conventional funds and try to explain why there is a demand for SI, these papers are because they're using monetary incentives as their key variable for analysis, they're leaving out things like altruism or signaling in the residual terms. So it's not explicit in the sense that they single out those factors and estimate the impact of those factors. And in our paper, what we do differently is we're putting the analysis of why there is a growth in SI demand into a SI versus charity setting. So in that sense, we're directly putting altruism as the right-hand side independent variable and estimate our results. So before I go into more details about what we do, let me just first highlight two papers that I think are relevant to our research. So the first one is by Hartzbank and Sussman. So these authors examine, why individuals would change their investment from low sustainability rated funds to high sustainability rated funds, and they argue that this is because of non-financial motive. For example, one of them could be altruism. And Rideau and Smith in their paper, although it's a small section towards the end of their entire paper, they conducted a odorless regression to examine whether the decision of being a sustainable investment investor is related to self-reported average yearly donation. So, you know, in Rideau and Smith, the problem with their methodology is that they're using the self-reported data on donation, which could be a noisy measure. And second is that the odorless regression could suffer from some endogeneity issues that cannot be comfortably ruled out. So what we do differently is we're going to use shocks to altruism, exogenous shocks. First set of shocks we're going to examine is, for example, shocks to emotions or altruistic feelings. These are towards shocks like environmental disasters or humanitarian crisis as listed out in panel A of table 1 here. So we examined the BP oil spill, for example, as a representation for environmental disaster, and also the refugee crisis in 2015 as a humanitarian value crisis, and also in 2017 when the US announces a withdrawal from the Paris Agreement, which is a environmental type of shock. So under each of these shocks, what we're expecting is that individuals' feeling or altruistic motive would grow stronger, so that we could see both donation flows and flows to SI increase afterwards. However, there's a slight limitation with this set of natural disaster shocks, is that, you know, under these sort of one-off disasters and events, it could just naturally be that donation or charities are more just naturally attractive and easier to access for individuals compared to SI funds, which may sometimes require more time to search for or a longer term commitment. So you know, so under these type of tests, if we don't find anything in terms of the flow of SI, it does not necessarily mean that SI's flow is not driven by altruism. It could just be that the donation is just naturally more attractive under these situations. So in order to counter this argument, we have a second set of shocks as well that directly impacts the attractiveness of charitable institutions, and they are listed here. So in panel B, we see that we're using scandals to charities. For example, in 2011, there's the allegation of managers' inappropriate behavior for the Oxfam charity, and also a couple of others in the US and UK. Also, we're examining tax policy as a shock to charitable institution attractiveness. In 2017, the US government announced that they will be implementing a Tax Cut and Jobs Act in 2018 effective, which essentially decreases the attractiveness of using donation as a means of making tax deduction. So under this second set of shocks, we're expecting donation flow to decrease as a direct result, and we're also expecting the flow to SI to increase. Now, this second set of tests also answers the question whether donation flow are driven by altruism, and it's even a stronger test because it directly impacts the attractiveness of charities. And in this set of tests, we're also able to see whether there is a redirection from charity to SI. Now, let's talk a bit more about the research design. So we're essentially doing two sets of tests in diff and diff, using diff and diff. The first set of tests is going to be based on donation flows, and the second on fund flows. So we have two countries that we're analyzing here, the US and the UK, and our time frame spans from 2008 to 2018. Our treatment control group, so for the donation side of analysis, we're able to construct sharp control versus treated by shock relevant charities and shock irrelevant charities based on, for example, if it's an environmental shock, we're examining environmental focused charities versus non-environmental focused charities. And on the fund flow side, we're examining the before and after differences in the SI fund versus conventional fund flows. So as robustness checks, we're also including relevant versus irrelevant SI funds in our analysis. And we're also including institutional dummies, whether a fund is institutional or retail. And we also test for alternative post-shock years in order to make sure our results are robust. So the data, I'll quickly go through this, is coming from, so on the charity side, it comes from the Charity Commissions UK and the Internal Revenue Service in the US. So both data sources allows us to identify clearly the purpose or the features of charities so that we can construct our sharp definitions of treated and control group. Now, the Morningstar is our source for financial data of SI versus conventional funds. And let me move on to my results now. So in the first set of tests, which involves natural disasters and humanitarian shocks, you can see clearly from the first and the third column here that charities in the US and the UK reacted strongly to these sort of one-off disasters or shocks. Now the charity flow, while the charity flow responded, you see on columns 2 and 4, there's basically no response from the SI fund side. So investors are not changing their decision in whether investing in SI or increasing or decreasing SI investment. So, but as we said, you know, these type of one-off shocks could have some limitations. So we introduce our second types of exogenous shocks, which are shocks to charitable institution attractiveness. And in this set of tests, we examine Oxfam scandal, Cancer Fund of America scandal, and also the Tax Cut and Jobs Act in 2007. So in the Oxfam scandal, it predominantly affected charities in the UK. So if we take a look at the voluntary income change before and after the Oxfam scandal, and this hollow square diamond-shaped graph line is for Oxfam, and the dotted one is for British Red Cross, which is a similarly large charity. Both charities experienced a decrease in their total voluntary income after the shock in 2011. And if we think about, you know, whether this shock has a sort of industry-wide impact to all the other charities, we can look at the plot of total voluntary income by all the charities. We see here the larger sort of magnitude drop happened in Oxfam and British Red Cross, but still we see that all the other charities are also experiencing a decrease in their voluntary income. So, you know, although we observe this on the charity side, again, our SI fund flow does not show any changes at all. So this is already indicative that, you know, SI fund may not be driven by altruism. So if we talk about the Tax Fund and Jobs, Tax Cut and Jobs Act in 2007, we can also plot the income for charities in the US, and let's see what happens. So this graph is the total itemized charitable contribution filed by US taxpayers over time, and this point here is the year 2007, and you see after 2007 the total contribution received from individuals dropped substantially compared to you know, that although there is an increase in the adjusted gross income. So this is suggestive that the tax policy did have a strong impact on charities. But again, we see in the second column, this number minus 50.93 estimation here, that there's no impact on flows to SI. So, you know, just some conclusion. So our first set of tests, which are using natural disasters or humanitarian weather shocks, we see that altruistic motives drive donation, but they do not drive SI. However, you know, they, as we said earlier, these one-off shocks could be affecting donation more than SI. So we're moving on to our second set of shocks, which are stronger. tests for common motives, but still we see no impact from SI whatsoever. And this is then suggestive that it is even less likely that donation and SI are driven by the common altruistic motives. So the contribution of our work, firstly, we're contributing by providing an alternative approach to compare to existing work on examining why the demand for SI increased over the past years. And also we, in our research design, we're able to clearly identify altruism as a right-hand side variable instead of leaving it in the residual term. Now, we also contribute to the investor preferences literature for SI by arguing that there may be other non-pecuniary motives for sustainable investment, but altruism may not be one of them. Also, our finding is consistent with the opposing rankings of US versus Europe in terms of their development in SI versus philanthropy. And we're also sort of indirectly addressing the regulatory environment argument posed by Harsmark and Sussman in 2019. Thank you, and I welcome any questions and discussions, please. Thanks.
Okay, thank you, Silvia. Thank you for presentation. And Eran, you are the discussant. If you wanna.
Hello there. Yeah, let me share my screen now. Can you guys see my screen?
Yep.
And can you hear me clearly?
Yes.
Okay, that's fine. So first of all, I would like to thank Silvia for the nice presentation. So I want to start with a quick summary of the paper according to my understanding. So the paper investigates whether sustainable investing is driven by altruistic motives. So the argument set by the paper is that if altruism is an important driver of demand for sustainable investing, then events affect altruism so strongly should be reflected not only in charity given, but also in funds flows to sustainable investment. So therefore, the paper examines responses of sustainable investing and charity given to humanitarian and environmental shocks to altruism. So the study findings, the results show that altruistic motives drive donations, but not sustainable investment. So examining shocks to attractiveness of charitable institutions, which reduce the relative efficiency of the whole charitable sector to deliver altruistic goals, shows that there is still no impact on sustainable investment flows. Therefore, the paper concludes that altruistic motives are unlikely to drive sustainable investment flows. So, well, I would like to note that I'm not so familiar to this research topic. However, I really enjoy reading the paper, and it was well written and well structured. I find it very interesting. In fact, I developed some understanding into this research area after reading the paper. So I'm going to take a different approach. I like to talk about the paper part by part, starting with the introduction. So here are some of my observations about the paper. So, well, basically, introduction section of a typical research paper, needless to say, like a driving force that leads to the rest of the paper. So thus, it should be carefully written. In this respect, I can say that the introduction section of the paper is carefully written. It clearly presents the background and motivation of the study. It's the gaps in the literature and the contribution of the paper are all explained in a logical and efficient manner. So regarding the theoretical background, the paper illustrates a good understanding of the literature. The section critically evaluates related theories, concepts, and empirical studies regarding sustainable investment and philanthropy, like we show in the, Sylvia showed in the presentation. It was well detailed. Like I said earlier, I'm not very familiar to this area, but the paper seems to cover all important studies in this area, past studies and recent studies as well. However, I have a little suggestion here, and a minor suggestion. I think a table that summarizes the empirical studies mentioned in this part will be very useful, because theoretical background is presented in two subtitles, like sustainable investment and philanthropy. So, and then they included a lot of empirical studies. So it will be useful to follow for readers the literature, empirical literature in this part, especially readers like me who are not so familiar in this area. So moreover, I think the methodology and results section are the strongest parts of the paper. The methodology section explains the formulated research hypothesis and well explained the design and data collection. The models, research variables, and various analyses are explained in detail and nicely in detail. Also, analysis, main analysis and findings accompanied by various robustness tests. There were lots of tables supporting main analysis in terms of robustness tests. So the empirical results are clearly presented and critically discussed, especially usage of text, tables, and figures were simply excellent. And my final comment on the conclusion section. The conclusion section clearly summarizes main findings and identifies important conclusions of the paper. However, I have another suggestion here. First, what are the practical implications of the findings? And also, any particular limitations of the study, and what are the further research ideas? So that actually these points were actually touched throughout the paper conclusion, but I think more discussion by adding 2 or more paragraphs will be beneficial. Even in the presentation, Sylvia talked about some limitations regarding the sample, so on and so forth. I mean, there will be 2 or 3 paragraphs, like a discussion in conclusion will make it better. So then also the basically data regarding US and UK data. So generalizability of the result also should be mentioned there, because it may not be the case in other countries. So overall, I say that it was a very strong and interesting paper. It was a full, complete paper, and I really enjoyed reading it. Thank you very much. So that's my comments here.
Thank you very much.
Okay, if you want to reply, Sylvia, or otherwise we're done. Or any questions by the audience? I don't know. Okay, assuming you know, there is nothing want to ask something. I mean, thank you to all presenters and discussants. Thank you to all the audience, and hope to see you all guys next time in person and not online. Okay, thank you. Have a good time.
Yes,
bye.
bye.
Thank you.
Bye.
Bye.